So an in-depth analysis on the Irish financial landscape is what we'll be covering off today, but from an insurer's perspective. And we'll follow this by a deeper dive on a very hot topic in Ireland at the moment, which is real estate investment. Okay, so before we get started, some really quick housekeeping notes. We will be recording the webinar today for internal use, but please note that only speakers and the presentation will be visually and audibly recorded. You won't be. You might have already noticed that the panelists can't hear you. Attendees are muted so that our panelists can be heard clearly at all times. So please don't ask anything verbally. We will, however, be taking questions throughout the event, and we'll be doing this via the Q&A function at the bottom of your screen. So if you have any questions during the presentation, just please pop them in there and our panel will address them at the end of the session. You do also have the ability to upvote questions there. So that means if you see someone has already asked a question that you'd like to know, just give it a thumbs up so that we can see it's a popular ask. We want you to get the most out of this session. So we'll be monitoring this along with the chat to ensure that your question is covered off today. I can also confirm that the Insurance Institute has awarded this webinar with 1 hour of formal CPD, and certificates will be issued to all attendees afterwards. So moving on to our legal disclaimer, which I'm not going to read out, I'm just going to assume that you can all speed read it yourselves. But the one thing I will highlight is that while we will be sharing the deck after the event, please note that it is intended for the event use only. Okay, so now I'd like to introduce our speakers. For anyone who doesn't know me, I'm Francesca Kelly and I'm a Regional Distribution Manager here in Travellers. I'll be posing some questions to you throughout the session via the interactive polls, just to make sure you're all listening and paying attention to us. And in between those, I'll be handing over the technical content to our experts. I am delighted to introduce you, or rather reacquaint a lot of you with Mr. Sam Meehan. Sam joined us not too long ago, actually, it was just over a month ago. We brought Sam in to lead our financial institutions business here in Ireland. Sam has over 12 years of financial lines insurance expertise under his belt, so we are delighted to have him on board. A lot of you will already have dealt with Walid Youssef. Walid is our Deputy Head of Financial Institutions for Travellers Europe. Walid also has a wealth of financial lines experience and he's been involved in some of our largest FI placements here in Ireland. So thank you, Walid, for being here today also. Okay, let's get on to our first poll. So we're going to just ask you to place yourselves into your client's shoes for a moment here and imagine you're a real estate investor. So you have €1 million to invest in Ireland. Where are you going to invest your money? Just give people a few minutes to answer. €1 million, that would be nice, wouldn't it? Okay, how are we looking, Amber? Oh, okay, interesting. So the majority of you are going to invest your €1 million in the residential sector. Hold that thought. We're going to listen to what our experts have to say, but let's come back to this. For now, I'm going to hand you over to Sam.
I just unmute myself there. Thank you, Fran, for that very generous introduction. Certainly a lovely way to start the day. So thank you to everyone who's joined us this morning. I did have a look over the list of attendees and there's certainly plenty of familiar names there. So some that I have caught up with since joining Travellers, but plenty that I hope to touch base with in the not too distant future. So as Fran has alluded to, the first thing that myself and Walid is going to discuss is the Irish financial landscape. Now, before we get into the actual content, I thought it'd be best to provide a bit of context around why we, meaning the Travellers FI team, monitor a few of these key indicators. These indicators are something that we do discuss and monitor with a view of any potential impact on our holistic appetite. We'll explain in a bit further detail when we get into each one about what the impacts are on sort of financial institutions anyway. The key indicators that we do monitor being GDP, unemployment, inflation, insolvencies, and we'll also touch on the housing market. So before we get stuck into the content, I'll just head back to Fran, who I believe has got another quick poll for us.
Another poll, just keeping you all awake here. So what do you think is the biggest concern for the Irish economy at present? Is it housing prices, inflation, interest rates, unemployment? Just give everyone a moment. Okay, so the majority thinks that it is. Oh, kind of a mixed opinion, but more so housing prices. Okay, brilliant. Walid, can we get your thoughts on this, please?
No worries. Well, thanks, Sam and Fran. Good morning, everyone. I'm really pleased to be speaking to you this morning. I hope you find the session informative and hopefully have some useful takeaways. So with that in mind, let's get stuck in. So as most of you will know, the last 12 to 18 months, governments have planned for the worst as they try to take action to prevent the spread of COVID-19. Now, as we're all aware, public health measures were taken and almost overnight, economies began to shut down as these stay-at-home restrictions for whole populations were enforced. Now, unfortunately, the restrictions imposed left many industries reeling with minimal, if any, revenue coming in, prompting countries to use what's arguably been some of the largest stimulus programs that we've seen within the modern day. With Ireland being no different, the Central Bank of Ireland actually forecasted that GDP would contract by nearly 5% in 2020, returning to growth with 5.5% and 7% penciled in for 2021 and 2022 respectively. However, as you'll see from the slide here, the performance of Irish GDP has been nothing short of remarkable in comparison to the median of or the median GDP of the European Union, as well as some of its other peers globally, with this growth trend set to continue over the medium term too. So with that in mind, what have been the key contributing factors to the success of this growth in GDP? So firstly, we had a buoyant export market. Government stimulus packages such as the pandemic unemployment program and the employment wage subsidy scheme, which we'll touch on slightly later on when we look at unemployment. Higher than average savings ratios, which ultimately lead to an increase in consumer spending. So the reason why this is important for financial institutions is that strong GDP and all the facets that come along with it, so for example, consumer spending, can provide banks with growth in such products as mortgages and credit cards. Insurance companies generally experience fewer claims within these periods, yielding a better ROI for their investors. And on the note of investors, investment managers generally provide better returns as instruments such as equities normally improve during this period. So as we alluded, the GDP of Ireland has performed considerably better than what the CBI had first anticipated. So the 2021 forecast is now forecasted to produce double-digit growth in GDP, and this positive story is set to continue throughout 2022. So drilling into those numbers a little to gain an understanding as to how this has been achieved. As I mentioned, the export channels have grown quite considerably. And this has really outperformed pandemic-related issues. And what's more, it's really interesting to see an increase in service exports. Now, access to European markets is critical for investors across the globe. And for so many, for so long, usually using the UK for passporting rights, now unable to do so as a result of Brexit. There's certainly been a correlation between this and the significant multinational investment that Ireland has seen over recent years. Now, on the note of correlation, there is certainly a correlation between imports and investments and how they're intrinsically linked. Now, as mentioned, there is an influx of multinational investment kind of between 2017 to 2019. And again, this is probably due to access to European markets. And that's slowly been coming back down, and that's irrespective of COVID. Now, with this in mind, as multinational capital is imported, the import performance will ultimately be drawn down alongside any negative investment performance, which we're seeing forecast for 2021 at present. However, on the positive note, this is expected to experience some growth again in 2022. Now, another really important point to look at here is the savings ratio comparative to Ireland's peers within the EU, and ultimately how this is increasing consumer spending now that the economy is beginning to reopen thanks to the vaccination rollout. Now, higher savings generally leads to better consumer confidence. And as such, this is pretty much why we're seeing private consumer spending increasing, and we are seeing those positive trends throughout this year and next. So a quick note on how people are spending their money, and there's actually a tenuous link here as to why we're all here today. Now, the European Commission Consumer Sentiment Survey, bit of a mouthful, on how people are more likely to use their disposable income, found that of the sample size that they've taken, Irish households are actually mainly focusing on either house purchases or home improvements since the onset of the pandemic. Now, moving along to unemployment, the impact of COVID on the Irish labour market has been unprecedented over the last 18 months in both scale and the level of fluctuation. Now, the substantial variation in the unemployment rates since the beginning of 2020 reflects the tightening and loosening of public health restrictions that we've seen there. Now, a perfect example of this is the unemployment rate in 2020. Now, that was 4.8% in February. Now, when you compare this with once the pandemic gripped most of Europe, the COVID adjusted employment rate stood at 31.5% in April 2020, and that's just 2 months later. So when you take this into consideration, and as we previously mentioned, government interventions via such schemes as the EWSS and PUP helped to lower unemployment during this period. Now, a quick note that's worth mentioning is that those earning, I think it's €203 per week via the PUP scheme, will now move to job seeker benefits. And with that move, will ultimately reflect in an increase in the unemployment numbers that we'll see. So I think that's something that's quite critical that is worth looking through over the next quarter to see how that impacts the unemployment numbers. Having said this, the measures that they've taken alongside, the reopening of the economy have assisted the gradual reduction of this over the shorter term. Now, as we touched with on the past slide, the Economic and Social Research Institute is forecasting that the economy registers a growth of 12.6% in 2020. And with this, unemployment is now set to fall to 9% by the end of this year. Now, obviously, this is all based on, on the continued basis, that public health measures allow people to move freely and the economy continues to rebound. Having said this, should the worst occur, the health of the Irish economy is arguably in a much better position than others. Now, it's especially true when you look at the ratio of debt to GDP, as well as the annual deficit in 2020 and what's forecast for this year and for 2022. Now, when you compare this, for example, to the UK, whose borrowing has now exceeded its GDP, Ireland have arguably much more breathing room to install further measures should additional public restrictions prevent the economy from continuing its reopening. So with that, I'm going to pass you over to Sam, who's going to take you through insolvencies and beyond.
Thanks, Walid. So look, as we've sort of alluded to and put up there on the screen, insolvencies have actually trended downwards in 2021. However, it's fair to point out that we obviously don't expect this to happen moving forward into 2022. Look, there's a couple of key points to make here. One being there's a significant backlog with respect to the courts and obviously issues with COVID-19. So protective certificates being issued and arrangements being approved. There's just a huge backlog there that we expect to sort of obviously eventuate in the next 6 to 12 months. Look, in addition, we expect there to be a bit of a lag from companies that were either distressed heading into the pandemic or were impacted by the pandemic, i.e. hospitality businesses, etc., that have been receiving government assistance, which will no longer be the case. Now, why is insolvencies important to FI? Well, look, insolvency exposure is a huge part of any directors and officers' risk, be it a private company, a public entity, or a financial institution. So Look, while we do evaluate the financial health of our specific insureds for their own solvency concerns, we would have a particular emphasis on the exposure to private equity firms. We'd be monitoring what industries have been financially affected and try and identify what PE firms have exposure to companies in those industries, or ones that actually target specifically industries that we expect to be impacted by insolvencies. Now, also to touch on banks, it's a pretty clear correlation here. More insolvencies means more defaults. More defaults equals more disputes. More disputes equals more claims. Yeah, so moving on to inflation. Look, the first key point to make here is, what is the target CPI, which I'm sure a lot of you are aware of. Central bank has a 2% aim. This is the same for the UK and same for most developed nations. Now, as it stands, and this is based on the third quarter statistics that were released by the central bank first week of October, they're predicting Ireland to have their CPI slightly above that at 2.1% this year, but rising to 2.9% in 2022. Look, as a side note for comparison, the UK predicting to have inflation hit over 5% this year, while the Eurozone is looking at 3.4%. Now, why are we experiencing high inflation across the globe? Well, a few key points here. Global supply chains were decimated during the pandemic. We've now got bottlenecking problems for obviously supply chains there. We've seen constraints in the labour market due to freedom of movement. And a simple one there, the demand for oil and gas has risen substantially worldwide. Well, so what does this mean? Well, high inflation rates are a key indicator of an overstimulated economy or an overheated economy. And one corrective action there of monetary policy would obviously be interest rate increases to, well, supposedly put the brakes on the economy. So, look, based on the predictions for interest rates, it's very hard to see the UK avoiding an interest rate increase in the short to medium term. As a side note on that, 6 months ago, the general consensus across the board was that the UK would unlikely be impacted by a rate increase in 2021, let alone next year in 2022. So that's obviously changed substantially in the last 6 months. With respect to Ireland and the Eurozone, look, as we said, aiming for 2.2%, Ireland's looking at 2.9%, the Eurozone 3.4%. It's probably not as clear cut as the UK, so it's a bit harder to predict there. Now, with respect to financial institutions, why is inflation something that we've monitored properly? Well, from the banking perspective, higher interest rates, as we alluded to there, means bigger profits, but it also results in higher default rates. And as I mentioned before, higher default rates is obviously a key indicator for claim activity. From the perspective of asset managers, we'd be concerned with highly leveraged balance sheets that might not have the capacity and liquidity to cope with interest rate hikes. So moving on to house prices, which should actually lead us well into the next part of the presentation. Look, so basically, as you can see from the data on screen, and I'm sure everyone on this call here is well aware, the housing market in Ireland is very hot at the moment. We've got a situation where the pandemic has provided people with the opportunity to save, as Waleed alluded to in one of the earlier slides there. And now we've got, we have the huge problem of a supply shortage. So effectively, you've got your basic supply versus demand situation, which has arisen here. An interesting side point on that is that whilst property prices across all of Ireland have grown sharply in 2021, it's actually growth in rural urban areas that's outperformed when compared to growth in Dublin. This is presumably another byproduct of the pandemic, where people are probably taking advantage of the opportunity to either work remotely full-time or commute less to Dublin effectively. Now, it's also worth pointing out, and this is by no means a doomsday prediction here, but some of the increase that we're seeing here now haven't actually been seen since just before the last major crash in 2006. Now, from house pricing, we'll move on to the next part of our presentation, which is the current landscape of the real estate investment market in Ireland.
Just before you get into that, Sam, I'm going to give our brokers some food for thought with our next poll. So what do you think is the biggest risk affecting the real estate investment market? A few options here: tax conditions, interest rates, occupancy rates, or investment capital. What do we think? Are we looking, Amber? Definitely more of a mixed opinion, isn't it? Okay, so interest rates just taking the lead there. Sam, perhaps you can give us your thoughts on this.
Yeah, well, one of the obviously the hot issues there is tax concessions there, which I'll be touching on here. So look, whilst we're moving into the next part here, I just thought I'd touch on at a very high level where Ireland was coming from when some of these decisions were made to actually attract some foreign investment into the Irish real estate market. Now, unless you're living under a rock, you'll be aware of the global financial crisis and the fact that Ireland, off the back of a very overstimulated Celtic tiger, was hit pretty harshly. Look, there was a huge amount of debt within Ireland and a significant lack of credit capacity available, and the housing and property market had crashed. So effectively, in an effort to stimulate some growth and attract some foreign investment, Ireland went down the path of providing all sorts of tax benefits with the creation of some favourable conditions for investment vehicles that were effectively set up to rival the Caymans or bring some money into Ireland. Now, with a specific reference to REITs, which is real estate investment trusts, the generous decision was made to actually have no tax on rental profits, and in addition, they removed any capital gains obligations. So, look, all in all, it made for a pretty rather attractive investment. We had a real estate market that had collapsed and was showing signs of early recovery, together with some pretty generous tax concessions. Yeah, so where are we today? Well, as we alluded to earlier, the residential property market in Ireland is very, very hot. Commercial property, despite a few concerns around the impact of COVID, is still providing solid returns and equally performing as well, which Waleed will actually demonstrate in the next slide about some actual specific numbers there on that. Now, as for the housing crisis, I don't need to tell you guys, it's obviously a hot topic. Rarely a day goes by we don't hear this referenced by Mary Lou or Micheál Martin or one of our other esteemed political leaders. It's obviously a hot topic, not going away anytime soon. Now, what's the actual problem with the housing market or the housing crisis? Well, it's obviously much more complex than this, and I am oversimplifying here, but there are supply issues. You know, as a byproduct of supply issues, rental prices, and I'm speaking from first-hand experience here, relative to wages in Ireland are absolutely brutal. You know, there's simply just not enough dwellings being built. You know, some estimates report that in order to restore some semblance of balance, we're looking at an additional 10 to 15,000 dwellings that need to be built each year. And this is in addition to the already 20,000 that are estimated to be built year on year. Now, this is in addition to some strict lending criteria, which really make it hard for first homeowners to enter the market and build or buy with low multipliers on their earnings and high deposit requirements. This is when compared to peers in the UK or my homeland, obviously Australia. Now, with respect to REITs, as we alluded to earlier, it's a very hot political topic. There's a lot of bad press about so-called vulture funds coming into Ireland and buying up already developed property. And obviously that, some scare tactics going on about this, and we need to drive out this foreign investment, et cetera, et cetera. But when we look at the surface of the fact that we've got a supply issue here, is the solution really about removing some foreign investments and reducing some supply there? I wouldn't have thought so. That's an issue in the short term. anyway, look, it's a pretty sorry state of affairs, and you wouldn't want to be a young Irishman trying to buy or enter the housing market for the first time in Ireland. But look, I'm sure, like me, you've got high expectations on our terrific political leaders, and I'm sure they'll come up with some excellent solution in the short term. Look, another area I just wanted to touch on here is commercial occupancy and where we sort of see that heading. Look, are we going to see a trend away from the traditional office setup? Now, obviously, you've got your traditional businesses like law firms and accounting firms that are just desperate to get bums back on seats, and there'd be no concern about them renewing leases. But conversely, you've got tech companies or even call centres that have probably gone from moving towards a hybrid model, or in the case of call centres, people have probably been told to head home and never come back to the office. So it's going to be a real watch this space in the medium term or short to medium term to see sort of who's renewing leases, are they renewing the same occupancy, things like that. So certainly something to consider. Another case, which is currently before the courts in the UK, which I do appreciate, it's obviously not Irish jurisdiction, but there could effectively be some flow on from this, is we've got a high street landlord that's been unable to collect rent off the tenant. The tenant is now arguing that they were unoccupied during the pandemic. So as a result, their lease is void. Now, on the face of it, it would appear that they've got a lease, they're obliged to pay their rent. But obviously, if the tenant has a favourable outcome in their legal dealings, this could provide all sorts of dangerous precedents for landlords. So on that bright note, we'll head back to Waleed to provide some actual context and some facts and figures on why Irish real estate's a great investment.
Thanks, Sam. I'm glad you share belief in the Irish political system. Yeah, mate, it's very good. So, I mean, I just wanted to touch on the commercial property sector, and I think demand in this sector is demonstrated when you look at the chart on screen at the moment, and it's demonstrating the spread between commercial property returns versus 10-year Irish government bonds. So, I mean, based on what we're seeing here, I mean, the returns are favourable, in the favour of the commercial property investment space. And they've provided this over a significant period now. So it does suggest that investors that are looking for safe fixed income with greater returns than perhaps something along the lines of a government bond, and are prepared to have a slightly higher risk tolerance, will look to deploy capital within the commercial property sector. So based on these figures, it does suggest that the trends are going to continue, and investment appetite is still going to be strong for the commercial property space in Ireland. Now, on that note, there has been an abundance of dry powder over recent years. Investors are looking to deploy funds into a number of different sectors, but specifically the office sector has been quite buoyant in Ireland, and this is particularly relevant over the last few years for newer buildings, especially office buildings that have environmental credentials, as all stakeholders, whether it's alternative investment fund managers, investors, or tenants, that are seeking to have a portfolio of assets that are not just profitable, but sustainable investments that's going to satisfy the sentiment from all stakeholders, as well as the ever-increasing reporting requirements that are coming about, such as the Sustainable Finance Disclosure reporting requirements. So with that, and on the note of SFDR, no investment discussion is complete without a little bit on ESG. Now, investment managers have never been more cognizant of the emerging risks to their investments and their portfolios. And this is no different for the real estate space either. In fact, the Royal Institute of Chartered Surveyors are actually basing valuations, although not in their entirety, on ESG traits possessed by a property. And what's more, the greener the property, the more green that investment manager is going to yield as a result. So valuation focus on all three facets of the ESG abbreviation. And it's in the investment manager's interest to ensure that as many of these are realised within their investments. So we've got some examples of the different types of sort of correlations between real estate investment and ESG on screen at the moment. Some highlights that I think are worth focusing, one from each bucket that are emerging at the moment, is construction materials and the different techniques that are used. Now, it's never been more prevalent for developers that are, to attempt to use more sustainable materials, whilst also looking at new construction methods to complete projects. So, for example, the use of eco bricks, the emergence of 3D printing of buildings are just a couple of ways in which investment managers and property developers are working in tandem to change the way that they develop properties. Health and well-being of staff is also a very topical subject at the moment, and especially during the pandemic and the fact that the way we're coming back now to this new normal. So ensuring that properties possess features that are positive to the employee's well-being is critical now. So, for example, making sure that there's ample lighting, having space in the age of social distancing is absolutely paramount, as well as exercise areas such as gyms and studios. They've become really commonplace in the office space and other type buildings as well. And this doesn't just mean the commercial space as well. Residential buildings with communal dwellings, generally speaking, are now having these types of spaces within them too. Now, the final point that we've got here is around the idea of green leases. Now, I think this is something that we're going to see more and more of. And essentially, it's to set the standards for both the tenant and the lessor, so that they both have a duty of care to ensure sustainability of the building and their obligation to upkeep these buildings to their green credentials. I'm dumbing it down somewhat, but it is certainly a topic that's emerging and something that we really need to watch out for.
Absolutely. Thank you, Walid, and thank you both. Before we head into our Q&A session, we thought we might try something different here. I'm sure everyone here can appreciate the complexity of the nature of financial institutions business. And, there's no simple submission form, I suppose, for each and every client. But if I can ask you both, Sam and Walid, to just take some time to explain to our brokers today the key risk information that you would need to know in order to consider a risk of this nature. Some guidance, I suppose, for our brokers when speaking to their clients and preparing their insurer presentations.
Yeah, thanks, Fran. Look, this is probably just a bit of a guide to, hopefully stimulate a bit of a conversation if you've got some clients out there and you sort of just need to work out what information to get out of them at a renewal meeting. So by no means is this an extensive list, or there's no real right or wrong answer, but there are a couple of key pieces of information that would obviously help us with our submission, or your submission, I should say. AUM, which is just assets under management or committed capital. So look, that's just about giving us a size of the risk, really. If it's a hedge fund with a couple of billion assets under management, great. If it's a real estate trust with $1 billion of real estate, we just need to know that basic information there. Leverage, so loan to value, it's important to understand that. We've got a number up there of 35 to 40%. Look, that's probably a good number we'd have for a real estate trust. So I would sort of flag that if it's above that, it's not necessarily something that we wouldn't write, but there's probably just a bit more information we'd need to know about the trust. That's just important, obviously, because we need to understand if there's some breathing space from external factors like interest rate hikes, which we flagged earlier on, but other things like market valuation fluctuations and even debt covenant obligations that the insured might have.
Yeah, absolutely. And just focusing on the next couple of points there, concentration risk. It's really important for us to understand the makeup of these portfolios. So higher concentration risks. So, we've used an example there of 100% being office space, is less desirable to us than having a diverse portfolio. I mean, ultimately, diversification just means that the portfolio isn't exposed to a specific sector when they experience times of stress. So, I mean, you know, to give you a perfect example of that, how the pandemic has impacted the hotel industry, if we were looking at a 100% invested portfolio in hotels, you know, we are going to see some signs of stress. Touch wood for that investment manager, things will improve for them quite quickly. But, you know, hopefully you can understand that's the reason why we're looking for the diversification there. Now, it is important to note that, you know, this doesn't mean that we won't consider an investment strategy that is very much channeled to one particular investment property or investment strategy, but it does mean that from an underwriting perspective, it does increase how we view this risk from a risk exposure point of view. Now, the WALE, or the weighted average lease expiry, I mean, as far as we're concerned, the longer the lease or the tenancy agreement, the more stable the returns are and the risk is from a revenue perspective. So, I mean, this is directly linked to the solvency capabilities of any investment trust. So, yeah, I mean, that's basically what we're looking for with that.
Yep. So next one, I've got their counterparty credit risk. So, look, how stable is the insured's clients effectively? To keep on going with the real estate trust example there, I mean, a dream scenario is that all the tenants are blue chip tenants with strong balance sheets that are unlikely to have defaults. Another point to just flag here on that, here in this time of sort of COVID or coming out of the pandemic here, is understand if there's any forbearance measures that they've currently got in place, i.e. was there rental holidays provided to some of the tenants? And if that was the case, is there recovery being sought, or how's that been worked out? Was it at a discount? Things like that as well would just be important to know in the current environment. Occupancy rates, that's a pretty self-explanatory, I would have thought. The higher the occupancy rate, the better. I would just flag there, we did see a couple of risks recently that were highly geared towards student accommodation. Now, both of those risks were very reliant on international students being obviously around, and the occupancy rates were pretty much shattered as a result of an outgoing of international students. So just something to point out there.
Absolutely, thanks, Sam. And just the last couple of points. Now, it's really important for us to understand the third parties that are utilised within these investment strategies. So to give you an idea of the types of third parties we're talking about here, so property and asset managers, firms such as Savills and what have you to manage the property portfolio, the fund administrators, those that are creating and calculating valuations and what have you, creating the investor reports, those types of things, and then third-party valuations as well, and the entities that are doing that. Now, you know, no risk is immune of litigation, but the use of more reputable firms in these respective fields, you know, we generally find reduces the potential for that litigation. So, for example, misrepresentation claims for fund reports, valuation disputes, and those such things. Now, the final point to touch on here is corporate governance. Now, that's, you know, always been a very hot topic for us in the D&O space, especially. And we just want to try and understand a bit more about the risk itself from a governance perspective. You know, the due diligence and the processes that are carried out during that investment phase, you know, whether it be from the pipelining and prospectus of potential investment opportunities through to the analysis, the acquisition, management, through to exit and realization of those assets. So something like a DDQ surrounding that is very helpful. And also the types of committees that are used, I think, is very, very useful for us, whether, you know, it's the exec committee, the investment committee, how often they meet, who's involved on those boards? Are the do investors have a seat on there, for example, within a private equity structure? Generally, some LPs normally sit on the board of an investment committee to have some sort of say in terms of what's going on within the strategy. So, and then finally, just board information, so experience of the directors, just so we can kind of gauge and get an idea as to the length of experience that they've had within the potential, within their respective investment field that we're looking at for the risk. So on that, I'll hand back to Fran.
Excellent, thank you both. And hopefully our brokers found that guidance useful as well. So on to our final poll of the day. You will recall at the very beginning of the webinar, we asked you to place yourselves into your client's shoes for a moment. And now, having heard about the market from our experts, has your answer changed? So you're a real estate investor, you have €1 million to invest. Where are you going to invest your money? Still residential, but there is a bit of a mix there. So a lot of you are very well versed in financial institutions already, but hopefully what you heard today just complemented your existing knowledge. So we'll move on to I think it's time for a Q&A session now. There's a lot of questions there. Let's see, we'll start with the first one. Okay, so can you recommend any good sources that you'd monitor or keep up to date with? So
yeah, sure. I would definitely recommend using the Economic and Social Research Institute. I think they have some very good quarterly updates in terms of how the economy is looking, especially focusing primarily on Ireland with that. And also, I'd also consider using the Central Statistics Office of Ireland as well. It's always very handy. Also, keep an eye out for EU publications as well, which you can probably find on the EU website as well.
Brilliant, thank you.
You have anything else on that, Sam?
No, that's same sources I would use there. Thanks, Waleed.
Covers off most of the resources there. Perfect. Sam, this one's for you. Where do you envisage residential property prices post 2022?
Well, I mean, as I said, I'm not a doomsday sort of scenario sort of guy, but it's pretty hot. So it can only go one way as far as I'm concerned, really. But surely growth has to slow down at some stage. Supply. There's going to be some government initiatives to obviously try and increase some dwellings being built. They've committed a significant amount of money in the last budget. Will that eventuate? I don't know. So, look, the short term, I think probably there's going to be a lag from the savings situation from the pandemic. It should flatten out in the next 12 months, but medium term, I'm not too sure.
No, fair enough. Thank you. What's your biggest concern for real estate trusts, and where do you see potential claims coming from in the future? So I'm going to ask both of you to give a bit of insight on this one.
Look, I mean, my biggest concern would be the generous tax concessions they've got at the moment, and if there's some amendment to those. I think it'd be a bit of a balancing act, obviously trying to appease the people or whatnot from a political sort of perspective to remove some of it, or at least reduce some of the tax concessions they've got. But I think it'd be a pretty big mistake to remove all of them. So that'd be a concern for mine, what's going to happen with that in the current political landscape.
Yeah, I think very much the same, to be quite honest with you. I'd say the political landscape is something that I would be quite mindful of, because, you know, there is a fine balancing act that you're going to need where you're, you know, appeasing some pretty disgruntled voters, I would say, over the issues that we're having around house pricing within our island, but as well as still making sure that Ireland is an attractive landscape for investors from overseas as well. And I think the overseas investment piece has obviously been a big area of growth over recent years. And I think any economy should still be striving for that. So I think the tax concerns that Sam had, along with the political landscape, I think that's certainly something.
Brilliant. This one will be a popular ask, and it's good to cover it off. What is your target business? So what is our FI appetite? Walid, I'm going to ask you to start that one.
Yeah, sure. So we have a pretty broad appetite looking at the asset management space, so hedge funds, private equity, mutual funds, REITs, but basically pretty much everything within that encompasses the asset management world. We're also targeting banks as well as insurance companies as well. So I would say that we do have quite a broad spectrum that we look through. If you want a bit more of a granular view of our appetite, I'd actually advocate going on to our financial institutions website. I think that's within there you should be able to find our appetite guide, which gives a bit more detail. But please feel free to reach out to myself, to Sam, Fran, and the distribution team over in Ireland if there's anything. And I do believe Amber's just put up the link to that as well.
Yeah, I'd just add into that as well that we do play in the sort of small mid-market range as well. So if you've got small funds with 20, 30 million under management, then that is for us up to sort of, it is a broad range, but probably up to a couple of billion of assets under management would really be our sweet spot.
Brilliant. Thank you both. I don't think you can have a webinar these days without mentioning the hard market. So do you see the hard market continuing for the financial sector? Sam, I'm ask you to answer that one.
Well, look, I mean, my answer would be based on discussions I've obviously had with my peers, discussions I've had with some brokers out there, and probably based on some papers publicised by some of the larger brokerages. But what I'm seeing, and by this I mean what I'm seeing if I'm on an excess position, I'm getting primary terms or vice versa, is probably 10 to 20% rate increases in the last month, I guess. And that's probably slowed down from 30, 40% a few months ago, and increases I'm sure some people were experiencing sort of in the 80 to 100% this time last year. So it's definitely continuing. We're not seeing reductions yet. It hasn't flattened out yet, but how long that continues for, it's not going to change in the short term. But the increases certainly won't be as drastic as what they were.
I mean, I think as Sam said there, remediation work has been going on for the last 12 to 18 months to try and remedy some of the premiums that perhaps were undervalued. Yeah, I mean, if you asked any investor, would you deploy £1 million worth of your capital for €600 to indemnify a real estate fund D&O risk? I'm pretty sure the answer would be no. So I mean, we've had to move the goalposts, I think, as an industry to ensure that we're yielding the returns for our investors, because I think every insurance company has stakeholders, and we need to provide those suitable returns.
Perfect. Walid, I think you might have covered some of this off in your content. Do travellers consider ESG when underwriting?
The short answer is yes. I guess. Yeah, I mean, it's becoming very much a critical part of our underwriting. I would say that what we are seeing at the moment, actually, and a lot of comments that we're having with clients when we're speaking to them, is the G is not an issue, because the governance side of things has always been a part of their investment strategy. It's now working out how the E and the S fits into their current investment model. I don't think we're seeing people rushing to make fundamental or wholesale changes to their investment process at this present moment in time. I think with new regulation, and what's going to come off the back of COP26 for after the next couple of weeks, it's going to be interesting to see how quickly people sort of adapt and evolve their strategies to incorporate this. But yeah, I mean, certainly it's something that we're looking at, and we see it more favourably when people are using the full array of ESG within their investment process. But yeah, I mean, at the moment, I think it's still very grey, so it's quite difficult for us to ascertain it. But
Yeah.
the long and short of it is we're looking at this on a case by case.
Perfect. I left this one for last. Where would you invest your €1 million?
Not in the casino. No. I have to say, I'm looking at this for a UK-centric lens, so my apologies to our Irish audience, but I mean, for me, I would be looking at distribution and logistics. The rise of e-commerce over the past few years has just meant that we need more of these warehousing, and they're presenting very attractive yields on a square meter basis. Very quick and easy to develop and set up. They're quite sustainable from a sustainability perspective as well. They're very it will tick a lot of boxes for that sentiment, and yeah, I think that's a very good investment for the longer term as well.
Okay, and what about yourself, Sam, from an Irish perspective?
No, I'm with the masses here. The rental yields on residential property too good to resist at the moment, and I don't think they're changing anytime soon.
We'd have good diversification in our portfolios.
We would.
Fantastic. So look, I think we've covered most questions off. If not, we'll pick it up with you directly after the webinar, of course. That concludes our Q&A and concludes our webinar for today. Thank you so much for taking the time out of your busy schedules to join us this morning. We really hope you found it informative and that you got something out of today's discussion part of the CPD, of course. Just to let you know that we will be forwarding the slides from today's sessions to all attendees, along with our FI appetite guide and a very quick survey. We love to hear from attendees and to take any feedback on board to help us improve our future events. So please do take a moment to fill this out. It shouldn't take too long. And more importantly, if you have a financial institutions opportunity on the go that you need our support on, or something coming down the line, please don't hesitate to reach out to us, whether it's via email or even better, pick up the phone to Sam Walid or myself and the rest of the distribution team. Myself, Carolyn Conlon and Jerry McLaughlin are always available at the other end of the phone to discuss a potential opportunity. But for now, thank you once again, and I hope you have a great day.
Thank you.
Thanks, guys.